Hello and welcome back to yet another video on my channel. My name is Sammy Badera, and in today's video we're going to be covering the 7 laws of investing. The idea is with these 7 pillars you'll be able to be a more sound and well-rounded investor. Without wasting any more time, let's hop into the first point. Number 1 is going to be a classic: time in the market is better than timing the market. This refers to it being better to put your money into the market on a consistent basis for many years, let's say 5, 10, 15, 20 years, than each year trying to wait for a market crash, buy a bunch of investments, and then wait till they go up really high and sell them at their peak. This is mostly because nobody has a crystal ball and knows when the exact peak is going to be, and vice versa, nobody knows when the complete bottom of a market crash is going to be. So overall, research has shown that it's better to leave your money in the market for long periods of time than trying to time it yourself. The second pillar is $1 today is worth 10 tomorrow. This expression basically goes to say that money today is worth way more than 10 years from now. And that's because if I was given $10,000 today or $15,000 10 years from now, I would rather have the $10,000 today. I could take that $10,000 today, invest it into assets that pay me a return every year, and I'll take that return, add it to my original 10,000 and do it a second year in a row, and then take that new return, add it to my investment and do it a third year, and that's what we call compound interest. The third pillar is one of my favorites, and it's an expression I'm taking from the great Warren Buffett, and I'm paraphrasing here, but it basically goes to say, I would rather own a company if their price isn't offensive than waiting around for the price to drop. So a lot of times you might hear people say, I'd love to own that stock, or I'm gonna buy that house, but the housing market is just so overpriced, or that company is so overpriced, if they would just fall by $5. This approach essentially says that if the price isn't wildly overpriced, if it isn't offensive to you and you feel like it's a little bit expensive but still a quality investment, that you should buy it. You should buy it and hold it long term and keep adding to that investment over time. The worst thing you can do is spend 2 years, 3 years, or even 5 years waiting for an investment to drop in price, and then what if it even goes up higher than the original price you saw it at? That will keep you up at night. The fourth pillar is referring to a common misconception that people who think that you need to save up your wealth to build your wealth, that each dollar you're gonna have when you retire is gonna be a dollar you save. But the truth is that rich people didn't get rich by saving every last dollar they had. Rich people got rich by making their money work for them. Let me give you a simple example. If I told you that you need to save $1,000 this year, and the best way for you to do it is for 1 month out of the year, you need to come up with $1,000. You take $500 out of one paycheck and $500 out of the second paycheck. You would have a really bad month the month that you choose to take that money out. You would see $500 go 2 paychecks in a row. But that exact same $1,000, if I told you that by the end of this year you need to come up with the $1,000, and I advised you that, hey, you should do it $40 per paycheck at a time. So then you would just do $40 twice a month for 12 months. Of course, I'm rounding the numbers a little bit, but that lands you a little bit under $1,000. And I guarantee taking out an extra $40 every paycheck would not be that hard for most of you. Pillar number 5 is a little bit more nuanced than the others. And it reads that if you purchase an asset that does not cash flow, you are betting that someday into the future, you will sell that asset to someone else for more money than you bought it. Essentially, what this means is that if you buy a stock that doesn't pay any dividends, a growth stock, you are betting that one day in the future it'll be worth more money than you bought it, and that's what you'll sell it for. The same goes for investing in stuff like cryptocurrencies that also don't pay cash flows, they don't pay dividends. It means that you're hoping that one day down the line they will be worth more than what you paid for them, and then you'll then sell them for that price. And not to say that anything is wrong with growth stocks or cryptocurrencies, but just so that you're informed that you will not be getting a return on any of those until the day you decide to sell them. I really like number 6 because it's one that I try to get across to my friends who like to talk investments with me. A lot of times people want to listen to the advice of an advisor or their friend or a family member, but at the end of the day, it's important to remember that investing is all about going with your gut. A friend of mine spoke to me about one of my last videos where I mentioned the different companies that I thought were good dividend payers, and started posing questions. And the thing that I was thinking to myself was that at the end of the day, It's all about what you believe is going to be there in 40 years. If you believe firmly that this company will be standing in 40 years, still be doing business, succeeding, and paying dividends to its customers, then you should be investing in them. And if you think that, for example, an asset like a home is at a fair price, or even if it's not at a fair price, that it will grow in value as time goes on, then you should pull the trigger and go into it. But no one is going to tell you when the perfect time to spend your money is, so it's about you. Investing is about going with your gut. The seventh and final pillar is a little bit similar to the fourth, but it's that the compounding snowball effect is far more powerful than simply saving money and stashing it away. To illustrate my point, I want to show you a little example. Alright, so for both examples, we're going to keep all the numbers and all the statistics the same. For the hypothetical scenario, we're going to start off with $10,000 today. We're going to go with annual contributions of $5,000. Again, mostly because of what the TFSA allows and because it's an easy number. And if you divide that to every single paycheck per year, you're spending about $200 from every paycheck to add to your investments. It's not nothing, but it's not a lot either. It's a fair amount. Now the difference here between these two examples is mainly going to be the DRIP, and we're going to set it to no, which basically means the dividend reinvestment program. It means that every single year the dividends you're paid for your stocks, you're not going to reinvest them back into buying new stocks. You're just going to take them as paychecks every single year. For the numbers on the side, we're going to have a pretty modest 4% annual dividend yield, expected annual dividend increase percentage of 4%, an expected annual share price appreciation of 4%, and we're going to let it run for 40 years. So for 40 years, we're only going to put in $5,000 per year into our accounts. We're going to take all of our dividends as paychecks and spend it as we please, and we're not going to reinvest it back into new stocks for dividends. So when you hit the button to calculate, we start off, of course, with our $10,000, and when you go all the way down to 40 years later, you're at a nice $523,137. Not bad, still quite a bit of money, but this is not reinvesting the dividends. This means that on your last year of investing 40 years from now, you're only going to be making $98,000 a year in dividends. Spending 40 years to get $90,000 a year is quite a long time. Let me show you why the compounding snowball effect is so impactful. If we leave all other variables the same and flip on this DRIP onto yes, and now you're going to see from year number one, everything we make in dividend profit, we're going to use it to buy more stocks that pay us more dividends. And we'll repeat that action for 40 years straight. So once again, we start with our $10,000. And as we approach down to our 40th year, the balance of our accounts go to $10,666,138. Now you could see how the $500,000 looks measly in comparison. And what's more is if you look at the dividend income from that year, would be $1,703,000 in tax-free dividend income just for your 40th year. Just for this example to get even more impactful, just by reinvesting the dividends, you would be making a tax-free income of $58,000 by the 24th year. And if you really wanted to compare it side by side, you'd be hitting the $500,000 mark, just like in the other example without reinvesting dividends where it took us 40 years. That same amount of money now takes 22 to 23 years to make back just because you reinvested the dividends. That is the power of the compounding snowball. And that is it, the 7 pillars to investing. If you found this video interesting or you've learned anything, leave a like on the video. Thank you for watching, and I'll catch you guys in the next one. Take care.